Welcome to Inside the Vault with Bank of Utah, your trusted financial partner. I'm Brandon Hanson, and joining me today is Tim Mehedy, co-founder and chief economist at Access Macro. Tim works closely with regional and community banks, helping make sense of economic trends, inflation, and interest rates, and what's actually driving the headlines. Tim will also be joining us as a featured speaker in our Economic Outlook events in February. Well, Tim, so great to have you with us at the Bank of Utah Inside the Vault. You know, looking back on 2025, some of the momentum from 2025 heading into 2026, a lot of really kind of messy economic data. Tell me what your thoughts are on 2026.
Well, first, thanks for having me. I always love talking with you all at the Bank of Utah. We had a great conversation a couple of weeks ago. I'm looking forward to this one. And I think you absolutely captured the right word for last year's data, messy. When we got it, it was messy. And so for those of you who were out celebrating Christmas early, which hopefully you were, on the 23rd of December, we got the third quarter growth numbers, right? And so we had some really interesting GDP shifting around last year. So in Q1, we had a huge explosion in investment and a huge explosion in imports, which counts as a negative to GDP as people got in front of tariffs. Then we had the complete opposite thing happen in Q2. And then we had a government shutdown, so we had no idea what was going on until right before Christmas. And so the big question heading into the FOMC meeting at the end of the year and heading into in the middle of the holiday season, I should say, was what was going to happen with consumer spending, which had been coming down for 2 quarters. That's the backbone of the American economy. And what was going to go on with investment, right? We had OB3, One Big Beautiful Bill came out, a lot of positives from an investment standpoint. How are all these things going to play out in the third quarter? Well, we had to wait. When we got the data, it was surprisingly positive. So consumer spending jumped up as a sizable amount in the third quarter, which was interesting. Yes, some of that may have been some rate easing by the Fed, but as I'm sure we're going to talk about, the 10-year Treasury didn't move all that much, which is the benchmark rate for the economy. And so borrowing costs maybe came down a little bit. And really what I think what happened is people just said, hey, look, we're going to go out and spend. We've lived through enough uncertainty now. We lived through Liberation Day and tariffs and then tariffs again. We lived through attacks on the Fed. We've lived through, there's wars all over the place, whatever, let's just spend. And that showed up in Q3. Now, interestingly, the investment data there was no contribution from overall investment in the third quarter, but underneath the hood, there was actually still pretty solid contribution from business equipment investment. And so going into next year, to your point, there's a sizable amount of momentum heading into the first quarter. And in fact, if you look at a lot of publicly available nowcasts are forecasts for the next quarter of growth. Many of them have popped up in the last couple of weeks to show that and are forecasting growth to be around 2.8 to 3.2%. It's an interesting time to be doing this because that is not what we thought when we entered 25. Even in the middle of 25, we were pretty worried about a recession, and those fears right now seem pretty far away.
Yeah, well, 4.3% GDP, that's a really incredible number. 2/3 of GDP is consumer spending, but all I hear about is the consumer struggling. What gives? How are consumers able to spend at that level given inflationary pressures?
Well, Brandon, you're hitting on like a major question we have in economics, which is like every survey that comes out says people are real miffed about the economy. They don't like it. They're mad about it. Inflation's doing stuff they don't like. It's like the pitchfork brigade is out. And yet, as you said, we're still spending, right? So what's going on here? Well, first, people are pretty ticked about inflation. And so that's showing up in their assessment of the economy. And inflation, just to be clear, there's two things that happen when we talk about prices. There's the level of prices, right? So you go pay, out here in California, $4.80 for some regular 87, right? And then there's the growth in prices, which is I'm paying $4.80 now and I was paying $4.70 last month, right? The change. Those are different. And so when you hear the Fed talk about it, you hear them say, well, inflation is coming down. They mean the growth rate is coming down. They don't mean price levels are coming down, right? There's a big distinction there. And that means people are upset about that, right? Particularly in the housing market. This doesn't get talked a lot about. I think, we just mentioned the kind of benefit of just people feeling better about uncertainty. But I think there's another force at play here, and that's the unaffordable housing market, right? I think what's going on is there are a lot of people that can't afford homes in their market that have been saving up money for a long time. And it sounds anecdotally like maybe some are just going, hey, we're not going to get mortgage rates where we were in 2018, 2019. House prices aren't going to see a 40% decline after huge run-ups during the pandemic. So you know what? I can't buy a home. And maybe now's not a good time to buy a home, but I got $50,000 in the bank. So I might as well go out and use that. So there's maybe some of that also playing into it. And just generally speaking, like while we don't have a dynamic labor market where people are getting hired, we also don't have a labor market that is shedding jobs at a recessionary pace. So all of those things kind of add up like little bricks in a foundation to give us some momentum going into next year.
Yeah, that's really amazing. So, economists look at recessions. The typical definition is 2 quarters of negative GDP. We just came off of one of the highest GDP prints we've seen in years. Probably not that likely that we're going to see a recession in 2026. What's your thoughts about the equity markets, the stock markets? Are they going to continue to hit all-time highs?
I put my disclaimer. Nobody should ever trade on what an economist says, right? Nobody. That said, or any economist. That said, though, it's been interesting, right? I mean, like this is another place. It's linked to GDP where like there's been like the end of the world is coming for equity markets for the last year, and yet we had another very strong year. What's going on here? Why are the forecasters wrong? Why are the analysts wrong? Why are we always waiting for the other shoe to drop? It's maybe a meta question on human nature, but the real piece is that when the economy's good and productivity is high, which I know we're going to talk about. It is, and there's a sector of the economy that's really driving that, which is AI and data center investment. It's hard to feel bad when consumers we're still buying, and you've got solid investment in a major future growth sector with a lot of productivity gains. That Q3 showed an enormous amount of productivity, and so it's really like, hey, how are you going to feel bad about that and about equity prices if the underlying fundamentals of the economy look strong, even if the Fed is not going to keep lowering rates? Like for a long time, we talked about what was the stabilizing or what is the kind of ready, set, cruise control interest rate. And it looked for years like the Fed was well above that. Well, we've lived through it. We haven't had a recession, and people are going, maybe the assessments of the strength of the fundamentals were wrong, and we're actually doing better. I'm going to go out and buy. I'm going to go out and invest in companies, right? Like maybe the future really is brighter than it seemed 12 months ago. And I think that's a fair assessment given what we're seeing in the economic data.
You look at asset prices going up, home prices, equity valuations. A lot of that is driven by liquidity in the marketplace. We've had times where there was quantitative easing, quantitative tightening. You've got a situation where the Fed has been decreasing the Fed funds rate. In fact, over the last 2 years, we've had 6 rate cuts, one of which was 50 basis points. And yet we didn't see the 10-year Treasury come down, but we have seen the yield curve normalize, right? We don't have this steeply inverted yield curve. How's that going to factor into home prices and mortgage rates in the future, do you see, for 2026?
We're just asking all the tough questions today, huh? Let me shake the crystal ball. What's going on in the mortgage market? It's been really, really fascinating and somewhat depressing. We had this perfect shock. I'll start with the mortgage market. We had this perfect shock of a massive run-up in prices, the principal of your loan, followed by a massive increase somewhat concurrently with the borrowing costs associated with your loan, right? Prices, then interest rates went up. So it's become an incredibly unaffordable housing market like we just talked about. That doesn't seem like it's going to unwind anytime soon, right? Generally speaking, when you have a huge run up in house prices, you would need an economic recession or some really bad choices being made in the housing market, like 2008, for house prices to reverse. They tend to reverse a lot quickly. They tend to go up over time and then reverse and kind of reset. It doesn't look like there's any kind of reset. It looks like the fundamentals in the market is there's not enough supply and too much demand. That's a whole different podcast we could do. But the housing market looks like there's construction looks recessionary, but the actual demand for housing does not. And that should tell you that there should be, we should not expect a big decrease in prices in the near term. Some decrease maybe. We may have hit peak valuations in certain markets, but not a big decline. Now, on top of that, to your bigger question around what's going on with interest rates, right? You said lots of policies and what's going on the 10-year. It hasn't moved in basically 2 years. And that's because we may have entered a period where people are reassessing risk and what compensation they want from that risk. So we talked about this in our webinar, but if you look at a very long time series of the 10-year Treasury yield, it's got ups and downs over decades, but it's been coming down for a long period of time. And then post-pandemic, it shoots up when the Fed raises rates, and it has been hovering at that high threes, low fours for a very long time now. That looks like what we call in economics like a structural shift, an underlying change in the way interest rates and financial markets work that undoes decades of previous psychology. And what it looks like is happening, if you look at the premia, the things that are involved in that 10-year, is that the world is uncertain. There are many things going on that we don't understand, from a political to a climate to a geopolitical, that is to a Fed policy communication standpoint, that's telling people, hey, look, people are saying we want more compensation to hold on to these longer term treasuries, and that's pushing up yields even as the Fed is lowering rates. So this has this weird effect of the Fed lowering rates but not being as stimulative as it would have in previous cycles.
So when you talk about assessing that risk and these structural changes, to me it sounds like you're talking about the fact that we're running $1 trillion deficit at the federal government level, and that we're over $38 trillion in debt. And people are probably realizing that government spending doesn't stop. And then obviously sort of the what do you call it, the canary in the coal mine is bond yields, right? And people are seeing those bond yields, and they're not coming down because of the risk they believe that the U.S. government represents. Is that kind of what you're saying?
Well, not to be too graphic, but we've gone through a couple canaries in the last decade. Just keep putting them up there, right? Canary, new canary. And it just feels like we keep getting to this point where we should be concerned about fiscal spending. You are absolutely 100% right that since 2017, we've had massively expansionary fiscal policy through tax cuts and then different rounds of stimulus. We cannot blame a political party. All political parties are doing it. Everybody likes to drink from the punch bowl. And so we're now at a place where we are at a historic level of nominal debt and a very high level of debt to GDP, which is how economists think about it. It is a real concerning development, and something that's going to impact more than people are talking about the next decade or 2 decades of policy. We've got tough choice on Social Security coming, Medicare, Medicaid, and then just fiscal sustainability. If what we're talking about and what we're discussing about structurally higher interest rates kind of going forward, then that means anything that you finance in the 2010s that comes due is going to be at a higher rate. Not to mention new debt is at a higher rate. So your financing cost, your fiscal burden of debt service is just automatically going up on top of any additional spending. And so we're really in a place where the fiscal deficit and the debt is pushing up rates. As you said, right? People are now like, well, that's inflationary, so we're going to want more inflation compensation from that. It's uncertain how they're going to handle it, so we want more risk compensation for that. And I haven't seen, maybe you feel differently, I haven't seen any indication from anyone within a 400-mile radius of Washington, D.C. about what we're supposed to do with any of even the low-hanging fruit. It feels very uncertain at this moment, and I think that is one of the reasons why rates are still high.
Yeah, I believe at some point, it hits a wall, bond yields soar, sort of like what happened in England with Liz Truss, right? I mean, everybody lost confidence in the bond market, and that really was, again, the canary in the coal mine that signaled that there needs to be these significant changes to fiscal policy, or we're going to kind of run off the cliff. I suppose some of this factors into why gold prices are so high, and then, of course, we've seen Bitcoin hit all-time highs recently, but I think gold hit an all-time high yesterday. Is that part of what's driving those price appreciations in those markets?
Absolutely. I mean, we're going to see, it's not just all-time highs we should expect. We're going to get lots of all-time highs. And silver was also recently there, right? Like you said, crypto. But the real thing that we're going to see a lot of, is a lot more volatility, ups and downs. right? It's been interesting. I don't want to tiptoe too far into what's been going on with the Fed, but like it's remarkable if you look at Monday's market reaction and today's Tuesday the 13th market reaction to the CPI report, right? This weekend, we had a new first, a investigation into a Federal Reserve chair. Right or wrong, that just happened. That has never happened before. On Monday, what would have happened in 2024 is what happened in April last year, which is you had equities fall out the bottom, treasuries go up, and the depreciation of the currency. Those three things together is just an outflow of money from the U.S. financial system. That's a fear-based, I don't want to be in the U.S., I'm taking my money out of equities, I'm taking it out of bonds, I'm going abroad. That's what would have happened in 2024. That's kind of what I want folks thinking about as we enter into the next decade. And that comes on top of, and I would love to just throw this out to Washington. Hey, everybody, let's try and find some solutions to these. Some really big questions around what we're going to do with fiscal policy, with tax revenue, with Social Security, with Medicare, Medicaid. These are all really big questions that no one seems to be answering.
Yeah, I've been personally quite shocked at how resilient the market's been. When you consider the geopolitical events and things that are happening here domestically, any one of those things would cause bond yields to go down, kind of a flight to safety sort of play. But, Iran, Venezuela, ICE raids, I mean, you've got all kinds of destabilizing things happening around the world, and yet the market just keeps chugging along, hitting all-time highs. And again, bond yields have been pretty resilient to stay where they are. It's pretty fascinating to me to see all that going on. And maybe it's sort of like one of those scenarios where so much is coming at us all at once that you sort of just bury your head in the sand and think that you're going to wake up and everything's going to be okay tomorrow.
Let me ask you, Brandon, as a banker, when do you start to get worried about it? Economists are always worried. That's our default say. When do you, as a banker, start to worry about this stuff?
Well, for banks, obviously, a lot of our success is tied into how well the economy does. So if we stay out of recession, banks will do fine. The other thing that stresses banks is when interest rates change rapidly, either up or down, because, of course, most of our money is made on our spread between what we pay depositors and what we charge on loans. And so if you've got deposit costs moving up and down on you, but then you've got a 5-year, 10-year fixed rate loan, you take on that interest rate risk. So banks really love to see things be stable, interest rates stay the same for long periods of time. The thing that banks have struggled with the last few years is deposits, because when everyone's paying zero on their interest rate, you just keep your money in the bank because that's the easiest place to access it. But if you can move your money to a money market fund or something of that effect, and we saw $6 or $7 trillion leave the banking system to go into money markets because there was appreciable yield in those markets. And so that's kind of been the big challenge. But for us, it's all about the economy staying strong and minimizing credit losses when our borrowers have stress.
Well, that's an interesting point that I think is underappreciated by people that are not in banking, which is that, like, hey, we have to make money too here. And this instability makes it hard for us to compete with what is a very connected world, right? Like, it's not hard to open up a Schwab account or Robinhood should you feel the need to go pump some main equities and stocks. But like, as a banker, as a regional community bank looking at serving your community, this is a tough place to be, right? Like, you guys have regulations. You're not just going to jump into these new markets. There's all kinds of stuff to think about. And so I feel like you guys have to, like you're saying, you take the economic environment kind of as given. And that economic environment is doing this. And I'm saying it's probably going to keep doing this, right? So as a banker, and it's hard to go out there and I think adjust kind of how your policies are going and how how do you capture that interest rate margins, you keep people employed, so as we enter into a volatile period, which I think we're going to continue to see both from GDP, from employment. We haven't really talked about productivity yet and what that means. And from a communication standpoint, we've got a lot happening with the Fed this year that could be really interesting. How do you as bankers help businesses think about this uncertainty and where you're pricing things and what they should do about it?
Yeah, for sure. It matters with whom you bank these days. A bank with a good balance sheet, a lot of capital. And then for Bank of Utah, we've always found it to be important to be in the markets, right? You don't want your bank to not be there to serve you when times are troubled. So if we're not being conservative, we don't have the fortress balance sheet then how are we going to help our clients when that time arises? So we're particularly careful about that here at Bank of Utah. Hey, Tim, you mentioned productivity. I want to jump on that because we're printing money like crazy, and the one thing that sort of offsets inflation and all of that is productivity. One of the great things about Utah, I don't know if you've seen our labor force participation rate, but it's phenomenal, especially compared to the rest of the United States. But tell me about productivity and maybe the hopes of AI and how that might help us in the future.
I mean, you're right. Utah's going gangbusters, right? So I'm glad to hear you guys are helping your clients out because it is for all the other states. My home state of Oregon, that looks nothing like Utah from a growth jobs perspective, and so you all are sitting there on a very positive economic story. And some of that has to do with productivity. Some of that's very wise investments and very smart policy by the state of Utah. And some of that is just because our economy is entering a period that could be transformational. Now, I want to say could be, because if we look back at economic history, these types of transformational changes that go on are really done over decades, not years, decades of time, right? If we think about the steam engine, assembly line, your kind of macro 101 examples, even the computer. These things, they're invented, early adopters grab them, and then it takes decades for the rest of the people in the economy, businesses, and then consumers to adopt them and find ways to increase their productivity. Now, that said, the last couple of years we've seen some pretty decent productivity growth. And like I said, last quarter was pretty good. Some of that may be just mathematical calculations, right? So productivity is GDP divided by output per worker hour. Well, we had a lot of hiring during the pandemic. Companies aren't saying it, but they're kind of slowing down because they overhired a couple of years ago. But growth has been good, so that's going to mechanically push up productivity. But the other piece in there, and this is really hard to quantify, is that AI may be pushing us into this new period of really fast productivity growth or very solid productivity growth, depending on where you come out in the AI story. Now, what's interesting about AI is that there's a lot that comes from that, right? It's not just is each person in a chat bot typing things in, becoming more productive. It's how are businesses integrating what essentially is a kind of like smart, but not really well, how do I put this nicely? We use AI a lot in Access Macro. It's very smart, but it needs a lot of direction. So you need talented workers to learn how to adopt that technology and use it. But when you find that combination, it can really unlock a whole lot of opportunity. And then you add into that the infrastructure build that is needed for data centers, electrical grids, steel, all of that stuff, those knock-on effects of actual physical infrastructure to meet these needs. And you could see a huge boom to productivity over the next decade, which has a lot of benefits, right? It is both a way to get ourselves out of the fiscal mess, because higher productivity, higher growth, higher tax revenue. If you stop spending money, Washington, you can't meet higher revenue with higher expenditures, right? You got to kind of do one. But also, it could be disinflationary, which is interesting, right? We didn't talk about this as much, but high productivity means you're producing more goods at a kind of fixed input level. So you have more of something lowers that price. And so what could happen in 26, 27, and 28, if we do get a big productivity shock, is that could help the Fed bring inflation back down faster than if we had just kind of lived in the 2010s productivity world. There's a lot of benefits. Productivity is kind of this, it's this, I'm trying to come up with an analogy, it's totally left my mind, but it's this kind of perfect unicorn of things that economists want, because it has all of these benefits to society. And it is possible, and early data is kind of indicating that we may be entering a new period of high productivity growth.
Yeah, that could be really incredible. Let's talk a little bit and maybe just finish up talking about the labor market. So we just got the labor market data this last week. 50,000 new jobs. Maybe we're not creating as many jobs as we have in the past, but I'm curious your take. Do we need as many jobs created if we don't have the in-migration, whether it was legal or illegal in-migration? Do we need as many jobs if the population growth isn't as robust? What's your thoughts on the labor market? And clearly the labor market's balanced. I mean, 2 or 3 years ago, employees could take 1 to 5 different other jobs that all paid better than the one that they were in. And now it doesn't seem like those opportunities are like that. So things are balancing out. Employers aren't forced to give out the big raises because people don't have all the options they had a couple years ago. kind of what's your view on the labor market and where it's going to progress and how in-migration maybe affects what we should be looking at in that area?
I'm thinking back to my basement apartment that we had as an office back when I was at KPMG back in 2020, and the whole discussion was like, how long will worker power last? It wasn't just wage increases. People were demanding to never go into the office again.
Right.
A new era of worker power, all be remote workers. Man, did that forecast not pan out well, right? People were back in the office. That power dynamic has completely shifted. And so that is because a lot of what you're saying is that we've had this, this demand in workers has slowed down. We are working on some analysis around this, but my gut is telling me, and anecdotally, that we had a huge surge in hiring, overhiring, lots of growth during the pandemic. And then we're kind of now slowing down and kind of catching up to what's been trend. Well, to the first part of your question, trend is also coming down. So it's not just immigration policy. And by trend, I mean trend employment growth. And by what does trend mean? It means like, what is the rate of job growth at which the unemployment rate doesn't move up or down, essentially, right? Now, there's a lot of things that go into that. One is migration, but that's really a discussion around labor force growth. And what's been happening for decades, before we even get to 25 and the immigration discussion, is that our population has been aging for a long time. So if you look at this total labor force participation for decades and decades and decades, going back to the 50s, it rose almost monotonically means just consistently upward, as women entered the labor force. And then around the late 90s, early 2000s, it kind of plateaus. And something interesting happens each time, and baby boomers, of course, entering the workforce. Each time we've had a recession, the labor force participation rate has dropped, like you would expect, and it's never returned to that pre-recession peak. So it looks like a bunch of stair steps going down for the last 2-3 recessions. And so what that is telling us is that we are structurally, the availability of labor in our economy is changing. And a lot of that has to do with the fact that our population is aging. We don't have nearly the same growth, birth rates that we had before. In fact, I think the CBO, Congressional Budget Office, is projecting we're going to have actual negative birth death rates here by 2031. And now we're not making up with immigration, right? Because immigration is an outflow. So the two things you need to produce labor force growth, which is going to be your supply of labor, are headed in the wrong direction. And so that means you don't need as many jobs every month to keep the unemployment rate from going up. That's an interesting piece, right? You can have maybe 50,000, 20,000 jobs is the same as having 150,000 jobs per month added, 10, 15 years ago. But what that also means is it puts you closer to that negative territory. So before, in the old world, you get an announcement of, 15, 20,000 people were laid off at this company this month, whatever. That 15, 20,000 at a lower trend job growth number could be enough to put the entire economy into a negative print that month. So where negative prints used to be a lot less common, we could be in a period where they don't mean the same thing they used to because one company has driven that, numbers that month in a way that we haven't expected before, which makes it, to your point around messy data that we opened up with, much harder from an economic standpoint because job growth is one of those things that almost always is positive in a expansion. And now we could have an expansion where it's month to month. It makes it hard and it's also one of our best sources of real-time data. So it's going to be really hard to judge the health of the economy going forward.
Yeah, it is a very precarious time, just all the things happening in the country and the world, and coming out of this pandemic where trillions of dollars of stimulus money was helicopter dropped into the economy. I think we're still dealing with the aftermath of it and may take a decade for that to really normalize. So really interesting times for sure. Really appreciate your time, Tim. Looking forward to having you in person here in Utah in February to meet with our clients and prospective clients. So thank you for your time.
Thanks so much. Have a great day.
From all of us here at Bank of Utah, thank you for listening to Inside the Vault. We'll see you next time.